I suppose you've been busy making lots of money by the looks of things. It's all upward, upward, upward for the oil markets.
Sean, I can't hear you. You're frozen.
I'm frozen. Oh no. Am I frozen to you too, Christof?
No, your mouth is moving.
Your mouth is moving, but can you hear me?
Yes, I can. Yeah.
Okay. Mike, can you not hear me?
I lost you for about 20 seconds. You're fine now, but your picture is static.
Your picture is static. Okay.
Now you're fine. Now you're fine.
Okay. So I was just saying, Mike, for you to kick off, all markets up. We're banging on the door of 60.
Indeed. We haven't quite printed 60 yet for front month Brent, but 59.79 is pretty close. And it was a $5 up week, which is quite phenomenal. The market is clearly getting ahead of itself in terms of a post-vaccine euphoria, but also continued belief in the ability for OPEC to manage supply, and confirmed in their intended outcome, which is to see global inventories decline. We continue to see declines in inventories around places, although, and I hope we can come on to this a little bit later, it's not geographically balanced just yet. But the euphoria is really underpinned by the pace of the vaccination. Now, having had the benefit of sitting this Sunday session out for 2 or 3 weeks, and thank you very much, Sean, for letting me do so, I have to reflect on where we would have predicted the world would be on a vaccination front, maybe sometime in November last year. And I don't think anybody would have called for or predicted the pace of vaccinations to be as pronounced and as effective as this. And not just that, all the vaccination manufacturers, all the vaccine manufacturers are getting tested and approved. And while some are coming to market faster than others, and whilst there are some complaints about the supply chain and delays, on the whole, it is just phenomenal to see the news report this morning that there are 130 million vaccines that have been administered so far. And that in some European countries, 1% of the population is already fully doses. So, of course, it's a long trawl. I mean, they're saying the US will need till September to get everybody their 2 doses. But in this tense winter battlefield between the vaccine going rampant and the vaccine intervening, the vaccine seems to be winning in the minds of the financial markets.
Christof Rühl, welcome back to the table. In all the euphoria, we had a jobs report out last week, which showed that the unemployed number in the US is looking increasingly concerning as the bulk of that number is now moving into that sort of dark zone beyond 6 months of unemployment, where the long-term legacy and consequences are quite significant. Your outlook from the week past, Christof?
Well, I think in general, the bulls are out. Despite this employment report, the general perception is pretty clear. The vaccine is coming, it's working. The predictions actually was that it would go much faster, at least in Europe, and 1% in Germany, for example, is considered to be ridiculously low compared to what was promised. But financial markets are trading the future, and it doesn't matter. So the picture looks bright today. What you're referring to, the stock market, the employment report in the US, is what some people call like a K-shaped recovery. That's the latest, right? Where the upper echelon of income receivers, they see their incomes going up and recovery proceeding nicely, especially when you are in a stock market in a situation like that. And with the bulls out of the stable. And where the lower end of the income receivers, the poorer people, so pay the bill and go into long-term unemployment. But I think very important to note that beyond all, when the dust has settled of this tremendous adjustment which we are seeing, is which we discussed 2 weeks ago, and I hope we come back to that with some time because something has happened in that respect, of whether this wave of optimism and people spending the money they have saved and central banks keeping the floodgates open and the stimulus package being approved is hitting an economy where the capacity is so constrained that it goes into higher prices and ends with inflationary tears earlier than many people have expected. And I think the more the euphoria, the higher the euphoria, the bigger that risk towards the end of the year.
On that point, Mike, I mean, in terms of demand recovery, if the Main Street long-term economic outlook is what it is currently, still requiring stimulus, still requiring a life support machine, if you like, despite the vaccine. The vaccine, and it's, perhaps this stimulus package coming out of the US is ultimately. You can't hear me, Mike? Can you hear me, Christof?
Yes, I can hear you fine.
Sure.
Yeah. So Mike has got the problem. Perhaps.
So
yeah. Mike.
Sorry, I couldn't hear you. Sorry.
You couldn't hear me. I was just saying, from the point of view of how do these two things coexist, the idea that the long-term macroeconomic unemployment and possible second double dip in recession align with this euphoria in the markets and the demand outlook for oil. Mike seems to be struggling. Christof, can you take that?
Yeah, so I'd like to come back. I think something important has happened last week, and it wasn't an event usually. It was a piece, an opinion piece written by former Treasury Secretary in the US, Larry Summers. If, I don't know how, you remember 2 or 3 weeks ago, we had a big discussion on the inflationary dangers in the situation you described. And I took the position that this is a very real danger. Now, we come from an initial situation where this is not wasn't a big topic in the discussion of the stimulus package, because all the big shot economists on the Democratic side essentially said, we don't have inflation and we need to go for it to avoid a recession as first priority. They all lined up on that. Krugman, Blanchard, Janet Yellen, you name it. And on the Republican side, there wasn't much of the usual kicking and screaming about deficits and debt and money printing, because they just come out of 4 years of Trump, who had essentially done the same, increased the deficit, kicked the central bank to print more money and all of that. So there was something like an equal consensus that this huge package was needed. Now, on Thursday in the Wall Street Journal, and I would encourage people to dig it out and read it, in a short and readable op-ed, Larry Summers, one of the most famous of these guys supporting the Biden stimulus, broke ranks basically, and he said this is running a high risk of turning out to be inflationary. So you heard it here first. He sort of basically said the same thing we discussed a few weeks ago. And we can go into the details of the argument, but basically is to say, number one, people have this enormous excess savings, about 5 times normal savings. Number two, the 1.9 trillion stimulus now going to Congress is about 5 times more than the wage losses and the income losses caused by the pandemic. And that's in a situation where unemployment overall is improving, and where the economy in 2001 to take a big jump forward because everything, life goes online again. And number three, what people call the output gap, so that's the capacity of the US to produce more goods, is about $30 billion. So that's calculations by not by Summers, but by the Congressional Budget Office. So that means if you order more goods for $30 billion, the economy can produce it. If you order more goods for $100 billion, say it can't produce it, we go into higher prices. That's why that's an important number. But the stimulus transfers $150 billion per month, so way more than the capacity of the economy. That's his most important argument. That's exactly what we discussed 2 weeks ago, and that says that there is a high risk of the stimulus program triggering inflation, and that means dangers for stability on the one side, and it also means that the stimulus is largely transfers, that there's no money then for substantial investments in infrastructure, in green energy, and all these promised things, because the situation gets shaky. Biden is basically now throwing 15% of US GDP at a corona problem, of which some people say the damage wreaked by corona wasn't anywhere close that much. And so it is leading to overheating into a problem.
And it perhaps, Mike,
is out of the stable, so we will not stop that. But the fact that these people are breaking ranks shows me that this is much more serious than most people realize.
That's it. Mike, I don't know if you can hear me now. If you wanted to just try and see if you have better bandwidth with your video off. But Mike, given this euphoria and this optimism in the market, I'm wondering from your perspective, what are the obstacles that could come to interrupt it? I mean, it does seem that we do have a duality here, right? We have some double dip recessions. We've got unemployment at very significant levels in many places. and yet the oil price is reflecting a fairly powerful demand recovery into the middle of the year, now trading March, April. What do you think are the possible obstacles that could interrupt this recovery in the oil price?
Yes, Sean, it is as you say. I have such difficulties here. Okay, let me.
I have a very bad echo.
Yeah.
Yes, I've switched to another device. I hope this is better.
That's much better, yeah.
Okay. My apologies again for the connectivity. It does seem to be my end after all here. I mean, it's all about China, right? We're heading into Chinese New Year next weekend, and there has been a disappointing view of Chinese demand for oil, even though we still have a world which is in steep backwardation and therefore pulling oil out of inventory, even in those places where savvy people had locked in contango 6-12 months ago on long-term bets that the market would stay oversupplied for quite some time. Everyone is saying that China has been extremely quiet, even dormant, and they cite things like high inventories, a resumption of a longer queue of ships waiting to discharge off the northern Chinese province of Shandong, and disappointing refining margins in China. Well, the Chinese have been adapting. The domestic prices have been raised in line with international prices. And all in all, I don't think Chinese demand has been quite as disappointing as some people have made out. It's just not been as rampant as perhaps it was before, when China stood out as the shining beacon in a world which was going through a demand slowdown. So really the world now is looking to the Western Hemisphere to catch up with Chinese demand, and for China obviously to get its buying boots back on after Chinese New Year. But we will see another 10 days of inactivity because we're going to get many parts of Asia with 10 days of holiday. And unless there's a quick buying spree in the next few working days, that'll be it until the second half of February. And we will have moved beyond the March trading cycle into the April trading cycle. And everyone's going to look at the usual things, refining margins and whether there's any evidence in the incomplete picture on Chinese inventories. So in short, China hasn't been as bad as some people have made out, but the onus is on the rest of the world to start with the demand catch up, because China can't consume much faster than it's already been doing. It's already outstripping its 2019 numbers and growing at a phenomenal pace beyond most people's expectations.
Mike, in the $60 point, although it's not quite there yet, but ultimately there on Brent, is that building in an expectation of a recovery in jet fuel being somewhat imminent, or where do you see the alignment with the excess demand or the idle demand that hasn't returned yet and the supply that is yet to return? These two things sitting out there as two big unknowns.
Yes, jet fuel is a huge part of the 6 million barrel a day year-on-year demand growth from 21 versus 2020, roughly half of it. And there are various Wall Street investment banks who have been quite big on the theme that jet fuel demand will resume for the summer season. I'd caution a little bit there, because the vaccine rollout just physically cannot give us the reassurance that travel as we used to know it will be safe and will be condoned. And let's not forget that most countries are still closed. Take Singapore, where I'm sitting. I can fly to Brunei and 6 cities in China, but I don't know about my terms of return. Changi Airport is closed to the world. The World Economic Forum that was meant to be loaned to Singapore from Davos in May was put back to the end of May, and then last week was put back to August. An acceptance that we just cannot get there by May, and it's not feasible to attract a crowd of 1,000, 1,500 plus high-profile delegates, even to a very safe Singapore, where cases in the community have been virtually zero. So I think the summer travel boom is probably a little bit of an overestimate. That said, economic recovery, driving demand, taking the place of jet fuel demand, is probably going to be illustrated very nicely in China again. If you look at the stats for what they call the Great Migration, I did a poll of the offices that we have in China. None of these guys are going back to the provinces where they have relatives. One lady had a home in Wuhan. She got stuck there for 8 weeks last year. Nobody's leaving Beijing because of the general guidance and the fear of being caught in a city where the government just locks you down in order to eradicate any flare-up in community cases. So we have statistics from China that travel demand in the early days ahead of Chinese New Year are down on 2020. And let's not forget, 2020 was already seeing the beginnings of the virus impacting not just Wuhan, but the whole of China. There are figures of 70% down on 2019. 70%. It's very preliminary, of course, because the big travel hasn't started yet. But employees are under guidance not to leave the cities. And that's definitely going to result in a huge drop in transportation fuels for the rail segment and for the domestic domestic aviation segment. Will it be?
That's yet to come into that's yet to be reflected in the oil price.
It's not the oil price at all, because the oil price is looking at the forward view. We have financial flows coming into oil, which, as I said in the previous call, is seen as a bit of a laggard in the broader spectrum of commodities. And yes, people are very much, as with many, many commodities out there, people are pricing in a future view rather than the present.
Yeah, and a very exuberant one. Christof, sorry.
Yeah, 70% is not quite in the price, but he's right. And I want to remind you of something else which we discussed previously, which is these relentless efficiency improvements in the way oil is used, which move on year after year. Apparently now we know, COVID or not, even in a world without COVID, they would be such that in a few years' time, we would likely get peak oil. Now, the calculations before COVID was that in order to get back to the 2019 global economic activity levels, to a global GDP as it was in 2019, you would need about 4.2 million barrels per day less in oil to support this level because of these efficiency improvements. If the recovery were happening in 2021, if it happens a little bit later, you need even less oil. So even with everything perfectly falling back into place, it will take a few additional years until we go back to oil demand as we had it in 2019.
Christof, in terms of the immediate outlook and the momentum that we've seen last week, the biggest 9% rise in oil prices, clearly there is a lot of momentum in the markets at the moment. Do you see anything in the immediate sort of short term first quarter that could disrupt this momentum?
Yeah, I mean, there's Corona Alley still, there is still this bouncing back and forth, including in equity markets where it's visible, between the fear of mutations or the failure of a vaccine or somebody dying from a vaccine and the optimism that the spring is coming and the dark winter is over and the vaccine is working. And then it has the desired effect of bringing first infection, then fatality and hospital rates down. On balance, I think there is a great deal of optimism. From the little I can see, it's justified that at least in the spring and the summer, we will move forward and lose.
I mean, infection rates are coming down. I don't think they're necessarily vaccine related because the vaccines haven't quite got to that level yet. But the UK vaccine numbers, US vaccine are not vaccine numbers. The infection rate numbers have dropped quite dramatically in the last 2 weeks, even though the vaccination program hasn't got to a level yet where you would say would make that kind of impact.
There's a question to Mike in this context. What happened to this additional lockdown in China? I remember a few days ago only, they said they were locking down another 22 million people. And now suddenly all of this has disappeared, or I'm not reading it. So there's these opaque little corners still. But on balance, I think you're right. The optimism is justified. And it will result in a big economic push over the summer. But what happened there in China, Mike? Do you know?
I'm not sure which one you're referring to there, but the overall
there was the lockdowns around Beijing, the province around Beijing. 2 or 3 big cities were locked down a few weeks ago because of the resurgence in COVID.
Yes, that was Shijiazhuang, which is 11.3 million people, and the second city, which has 8 million people. So these are mega cities. They shut them down for a week, test everybody, and then open up again. So yes, and of course impose restrictions on travel, curfews, and don't let people in and out of the city. That is definitely demand impacting. And that will continue because that's China's approach to snuff this thing out and make sure that there is no winter breaking loose of the virus and loss of control. It's very important to stability for the economy. The other point on China, of course, is where the cities aren't locked down, which is obviously the majority of them. People are driving more, and the passenger car sales statistics are bearing that out. I mean, people are driving more than they're getting on public transport.
And there's no way that their transport is down 70%. I mean, at least not the gasoline fuel transport.
No, not consumption, but sales of rail tickets for long haul travel from Beijing into the nearby provinces where people come from are apparently down 70% or thereabouts on 2019.
Yeah,
but also down on 2020. Yeah.
But we're talking oil, so that's what I was referring to.
Yeah.
So, Mike, on the other data points week past, we've had obviously inventories continue to decline. rig counts continue to climb. Anything notable there? Those trend lines starting to have an impact?
I think the rig counts are still very far off the levels where you're going to see a huge shot in the arm for US output. Of course, everyone's looking at that equation. I think you discussed it with your panel on Thursday with Aldo and Carol and Rustin. So yes, the US will clearly respond favorably. And the reason we have such a steep backwardation in the market today is that producers are selling hedges at the back end of the curve. I mean, it's just too attractive not to for vast tranches of the US shale environment. But as was also highlighted in your last calls last week, we have a lot of reluctance to lend, a lot of uncertainty around legislation from the new administration.
And that will be a hurdle for shale. Let's go to the room and give everybody a chance to cast an opinion on this narrative. What is the biggest concern for the continued rise in oil price? OPEC plus compliance, vaccine rollout, Saudi abandons unilateral 1 million barrel per day cut. The biggest concern for the continued rise in oil price, there's probably some others there as well, but welcome your views on that before we turn to everybody, to Mike and Christof for outlook for the week ahead. Christof, looking forward, there is one notable event going to happen in America, which is the second impeachment trial of Donald Trump. I'm kind of in two minds to whether that's a big event or not. But nonetheless, what do you see in the coming week worth paying attention to?
Well, this debate on the stimulus within the Democratic Party. Otherwise, I was trying to sort of Google what happens next week. It looks pretty calm to me. The impeachment, Trump, I think Trump is fading. I think he's overrated. He's a bully. He has been bullied back. And then with most of these cases, he has lost his Twitter account, obviously. I think he's sort of gradually fading from view. And at least for the time being, nobody is too keen to have him back. So that will not be a big event. It might even be a political mistake to give him that kind of attention. But otherwise, I think what is interesting to look at now is Europe, to the extent to which the numbers are coming down in some countries and exploding in others, how they will ever sort this out, the European Union. Germany now has infection rates coming down very nicely, so they should be in a position to loosen up pretty soon. In Portugal, they're exploding to the extent that they now have asked for support from other European Union members. In the UK, there's still the severe lockdown in place, which has never worked before in that particular country, but it's now supplemented with a very successful vaccine rollout. So the picture still is not uniform, and that's, of course, with a pandemic, that's dangerous because it means it's always somewhere and then coming back. And the question is whether the Europeans can get their act together, as the Americans probably will, to prepare for the spring and for the summer so that COVID is really banned and relegated to some dark corners and it's not dominating the headlines anymore.
Christof, the other thing that took note of, and I welcome your view on, is that the commentary between Russia and Europe reached a bit of a low point last week, or described by the participants as the lowest ever for a while. I'm wondering, is that something to watch? Yes.
I mean, Russia has, or the Russian leadership, I should say, has maneuvered itself politically in this isolation, which is really sort of getting severe because they are losing the last vestiges of support they had in Europe. Some German minister went public with the following comment. It was about Nord Stream 2. He said, no, we should not disrupt it. And the only reason is because it's the last bridge which we have to talk to Russia at all. So this, of course, comes on the heels of a murder in Berlin, which allegedly was done by by Russian secret services. And on the heels of Navalny being first poisoned and then sent to prison, and of the demonstrations in Russia. I don't think the situation will become like Belarus any day soon, but it's certainly not just isolation of Russia, but also an increasing pressure within that country, with people being very increasingly unhappy, and I think rightly so. On the other side of that token, just to another thought, it doesn't look as if the Biden administration is keen to either have smooth relationship straightened out with either Russia or with China. There was a very acrimonious call of the new foreign minister with his Chinese counterpart. where he sort of, read him the riot act, and that is not a very promising start. So globally, in terms of international cooperation, it looks still pretty dark.
Let's come back to Mike for the last word. Just get the survey result in. Biggest concern, vaccine rollout, Saudi.
If you would have put in shale, I wonder where that would have been.
Shale. Mike, the other thing that was in that speech last week with the U.S. foreign policy speech was some sort of signals about Iran could be something that comes back as well this year. But generally, looking to the week ahead, Mike, what's on your thoughts?
Well, now you mentioned Iran, there was that very interesting article on a ship called the Achilleas, allegedly carrying Iranian material, arrested. There is no abatement of ships that are turning transponders off in sensitive areas and doing transshipments. And unfortunately, the world seems to be, well, that part of the world that wants to trade these barrels seems to be testing whether under the Biden administration there will be any more relaxed view in terms of enforcement. So I think the fact that a ship was apprehended on top of the ship that was apprehended in Indonesian waters previous week is a sign that the new administration is keeping an eye on things. Now, whether there was dialogue between the Indonesians and the Americans is doubtful, but this Achilleas is certainly such an example. So policy in Iran is very important. I think most people in the market do not expect there to be any acceleration of discussions, even though it's tempting to see the JCPOA put back on track again, and Biden has appointed his relevant staff to work on that. But I think there's still very big question marks over Libya. I think I said on a previous call that Libyan production had very little upside and only downside, and there's some question about where the money's being paid to and whether there's going to be any impact in what's going on there.
But there was relatively good news that they seem to come to some political arrangement regarding the creation of a new government in Libya, which from a medium to long-term stability should be positive.
Indeed, yes. My point simply is that it doesn't seem to have been resolved yet exactly who gets the money, and therefore that always results in this. And of course, there are still forces from foreign countries on Libyan soil in sort of gatekeeper capacities, which sometimes doesn't make communications and access to infrastructure quite as straightforward. The situation in Myanmar is worth noting. I mean, Aung San Suu Kyi had a very high profile and a very positive rapport in the West, but the Rohingya crisis basically put paid to her reputation. And what we're seeing now is the major foreign direct investors in Myanmar are Singapore, number one, China, number two, and the West has very little economic interest in Myanmar, even though the UK is number 5 investor in the country. So absent any violence from the current protests, which are peaceful in the streets, military rule was the norm until 2011. There's a very real risk that unless the rhetoric steps up into action in terms of sanctions, this coup might just prove to be lasting and permanent. But whether that impacts trade and consumption is another matter. I mean, a country of 60 plus million people, but not of economic relevance, and the fact that it's got very little headlines and it's not seen as market moving has been quite telling. And then finally, it's cold in the West. I mean, the East has had its cold snap and we're writing off winter, and the big LNG price snap and electricity price surge that we saw in Japan and Korea. But the West is certainly feeling it. And that never hurts in terms of bull sentiment. I think that's been a factor also.
I think also the Myanmar story, it's worth sort of looking at what the bigger geopolitical picture here is, because there was a movement. Myanmar was, although, as you said, not the trading partners to the West were not as big as the regional in Asia, but Myanmar was looking and was shifting to a Western alignment out of the Chinese orbit. And I think there's a certain aspect of the Chinese orbit taking back a client state that sort of has ramifications for the overarching play in the geopolitics of Asia. And as we move forward with the new Biden administration, these are some of the chess games that are definitely worth paying attention to. But listen, Mike, thank you so much for your insights and contributions today. Lovely to see you. Christof, thank you as always. And everybody that joined us, thank you for your time. We look forward to catching up later in the week. Have a great, safe week, an economically productive one. And we look forward to catching up with you in the coming days. All the best.
And Good luck against the Welsh tonight, Sean.
Yeah,
Good luck.
exactly. Yeah. Cheers.
Bye bye. And sorry about the sound problems.